Hello and welcome to the EconBuff podcast. I'm your host, Lee Stitzel. With me today is Dr. Fritz Laux. He is a professor of economics at Northeastern State University. He researches in health economics and has a background in microeconomic theory. Fritz, welcome.
Thank you for having me, Lee. I've been looking forward to this.
Good, I'm excited. So, our topic today is tariffs. So, started us out just by briefly summarizing the situation with the current administration's tariff policy. I know it's changing quickly, so we don't have to get too far down in the details, but
Well, for people who have been living under a rock, yeah, there's been a lot of noise. And I guess one thing is Trump came out with a big bang with this long list of reciprocal tariffs, and there are a lot of questions about where these numbers come from, and a lot of controversy. There's talk about what's happened in the stock market. Um, And of course, this is all in the context where we expected that the Trump administration was going to implement tariffs pretty early on because it was a big campaign promise. They were going to deal with manufacturing in the U.S. So I guess that's just a start. I don't know how deep I should go into this, but that's just sort of the landscape.
yeah, I was speaking with a colleague earlier, and he was saying I could have, of course, predicted that there would have been tariffs. Everybody could have, but the nature of them is something that's a little surprising. Is that something that surprised you, or is this about par for the course for the administration?
I was surprised with the formula for calculating the reciprocal tariffs. Basically, this uh, the it's like a calculation for an implicit tariff based on the trade deficit with that particular country. Um, and then I was surprised by that, and I was like, well, I guess instead of jumping to judge people, I kind of look for my habit is maybe neurotic or something, but what was wrong with my perception? How come I didn't anticipate that? So,
Yeah,
and what I was thinking is, wow, this is a lot more complicated than I had expected.
yeah, same
And I'm
for
like,
me.
oh, okay, well, what they're trying to do is they're trying to come up with some way to deal with non-tariff trade barriers and act like those are tariffs. And of course, it's really a top level type media blitz is basically what Trump's doing because yeah, there's going to be situations where the U.S. has a surplus with one country, um, and then that country has a deficit with another country, with which the U.S. has a deficit. There's going to be roundabout trade, so
Yeah,
you can't just do things on a bilateral basis. But I don't think that was. I don't think the intention was to figure things out very well. If you have this kind of a formula, this trade gap formula as a basis for determining what the implicit tariff is, um, it's sort of a given that you're using a MEDAX or a top level approach. And so I was like, "Well, that was weird, but I guess if you want to make a big announcement, you need some sort of a top level approach. It's kind of above my pay grade, sort of.
so I'm happy to have you on. I actually was asked to give a talk about tariffs last week. Um, and basically the entirety of what I did was this is how economists think about it, and this is how a politician might think about it, and comparing those perspectives. So I want to get your opinion on that. What perspective or perspectives do you think economists could provide that would help the public in thinking about tariffs?
But yeah, I really like that. That's the same way I would talk about it. It's like if you're a politician, you're dealing with rational ignorance. The voters aren't experts. They're not really paying attention to these things. So it makes sense for a politician to be appealing to the base. They're facing a whole different set of problems than an economist would face. Um, but to me, I mean, uh, for tariffs, we got game theory, which clearly. I think the politicians the public almost sort of gets that. The idea of, well, for example, Trump talking about reciprocal tariffs.
Mhm.
So apparently everybody understands that strategic aspect of. I'm not saying he was doing reciprocal tariffs, but that using that language implies that everybody understands the idea of the strategic aspect of tariff policy. Um, uh, Tariffs are clearly a tax. So the logical framework to think about them is with if you're not thinking in the strategic terms, you think about it as what would be the right tax policy. Tariffs are very attractive as a form of sales tax because you can offload some of the burden of the tax onto the foreign entities. And then I mean, I guess the kind of stuff that that I like to talk about, which is alternatives to tariffs. We got a lot to say about that.
Yeah, that when I was given a talk last week I was driving home the point that tariffs are taxes. I wasn't It's not obvious to me whether the public thinks like that. I don't know if people are like, yeah, a tariff is a tax, or if I say that to people, if they're surprised by that. How do you think the public thinks about tariffs? Yeah, like you said, I think the game theory aspect, the retaliation, trade war, they think about that kind of thing. But I don't think they think about it as taxes. You want to expand on that part?
Well, maybe they look at it as the tariff is paid by the seller. So it's sort of like I don't know an example. When you go to Walmart, you think of yourself as paying the tax because it shows up on the receipt.
Mhm.
But I guess with a tariff, that you don't get your receipt doesn't include the tariff charge when you go to Walmart. Um, so maybe it's like that. I really don't know. I sort of I guess the public focus or the they would think about it as a tax if they got to the point of getting beyond the strategic aspect. Perhaps that's what's going on. The the public is saying, well, the Chinese are taking intellectual property. Um, there's all this political risk associated with U.S. investments in foreign countries. So the purpose of a tariff is to kind of level the playing field. So those are all strategic considerations. So maybe that's why they don't think about it as a tax. 'Cause they're focused. The first thing that comes, the top of mind issue is the strategic considerations.
Yeah, I think there's a reflexive reaction from a certain component of American society, which I'll just be upfront. Those are my friends. I'm here in Texas. So I have lots of friends on the red side of the aisle, and to them, that's completely what it is. So they're not very interested necessarily in taxes and trade deficit nuances from an economist. Not that that deters me from telling them about it. What do you think about Trump's strategy and what he's trying to achieve? And do you think there's a different way to go about that?
Well, I I think Trump's been very busy, and so my assumption is that he he wanted his team to come up with something big, and as a political strategy to fulfill promises made to the voters in the Midwest, we're going to bring back manufacturing. I think it makes a lot of sense. It's such a loud rollout of the tariff thing that there's no every voter in the Midwest knows that he did something. So, and I'm not sure his thinking on it goes that much deeper than that. I really, obviously I don't know. Um, uh, well, I guess his thinking would go deeper in the sense that he's been talking about tariffs for 20 years, and and that conversation, I think he's been focused on the strategic aspect. One thing I kind of liked, and this must have come from some economist lower down, somebody invented the terminology external revenue service.
That's clever.
Yeah, exactly, and that's something in a political sense, it's clever because it's easy for people to understand, and it's very catchy, and it conveys the idea of what is it that you don't like about the U.S. paying tariffs on our exports and us charging less perhaps on our imports. So it kind of puts a label on that, and I'm not even sure the tariffs. I haven't. This is odd for me, given that we're in a podcast talking about tariffs. I I haven't really focused on the relative tariff rates across countries. So I tend to think of the non-tariff trade barriers as the bigger issue.
Yeah, that's a good point. That sort of sets us up for a specific just discussion of why countries might use tariffs, and specifically then why might the US use tariffs.
And I was kind of proud of myself. I was thinking about the history of tariffs is really long. And so I think in the early days of governments, the royalty of you know the early Renaissance in Europe is they're the governments are raising revenue by issuing charters, selling charters,
Right.
basically selling monopoly rights, and then we start raising revenues by tariffs, and because tariffs are easy to implement administratively, you don't have any administrative
Mhm.
apparatus. You just need to put people at the port. There's going to be some smuggling, but as long as the tariff isn't too high, presumably the smuggling you can keep it under control.
Mhm.
And so if you have an early industrial society, it's easy to implement tariffs. And so I think it's something that people have understood for you know, hundreds of years. Whereas the more modern taxation schemes that we use are they're a little bit more mystical or something.
Yeah.
How does all this administrative
Oh, yeah.
apparatus work?
Oh, absolutely. The people, many types of taxes people don't understand at all. Income taxes, it would be a classic example of this, right? Not
Yes.
understanding marginal tax rates, not understanding, what your exemptions are, et cetera. So I think there's the pro-Trump side of the issue feels like I'm going to use a tariff, I'm going to make revenue, and of course you actually talked about that, some of which might be good, external revenue
Mhm.
service, and I'm going to bring manufacturing back as stateside. And I think a minute ago you alluded to, yeah, that's probably actually possible, and Midwest voters might like that. Can you expand on those a little bit?
Well, I think the Midwest voters are going to be happy just because of the announcement,
Yes.
because they're not necessarily going to follow the details of. Maybe to some extent, they'll follow the details of the resurgence of manufacturing if we have one. Um, but to me, the more effective way to to lower trade deficits is the question of whether manufacturing is the right, which industries are going to be the best for the United States is to me, that's something that we don't yet know. Um, but I think that the best way to bring back to lower trade deficits, to bring back productivity to the American economy,
Mhm.
is to lower trade deficits. And tariffs can do that. But that wouldn't be the first tool I would use for lowering trade deficits. I mean, tariffs traditionally are used more to protect. specific industries.
Mhm.
They're used for special interest politics, which kind of makes sense.
Yeah.
Um, and they can be a good source of tax revenue, um, assuming well, assuming you deal with the strategic issues, assuming the strategic issues allow that. Um, but bringing back manufacturing, but I guess protecting particular industries in the U.S., like maybe steel, aluminum. Um, let's see, um, high tech military stuff.
Yeah. Right. Yes. Okay. So, let me step back. You said you believe it would be a good thing for productivity to address trade imbalances. Is that your opinion, or do you believe that's a strategic
Well,
element of Trump's position,
I
the
think
Trump administration?
well, I think it's both my position and I think Trump's. It's within the Trump movement. I think it's their position. I'm not sure exactly how everybody. There's a lot there,
Yeah.
um, but a a way of expressing this would be there's a sense in which maybe the U.S. has been suffering from the Dutch disease
Mm,
because we keep on we get so much inflow of foreign capital that we don't have pressure to make things.
right. Yeah. So that's interesting. Do you view that y- your opinion and what you said there, your stance? Do you view that as something that fits with sort of traditional economic theory as it relates to trade deficits and productivity, or do you think you're a little heterodox in that area?
Uh, I guess the Dutch disease is mainstream,
Yeah, of course.
but I really I do most of my. I would have worked on this a while back had I not been doing projects on in health economics,
Of
right?
course.
So it's a little bit outside my field. I don't think I'm that heterodox. I think that there's the the textbooks are this clearly they advocate free trade, but they also talk about things like oh promoting investment in plants and the things that relate to not having completely free trade. If we could steer investment toward capital, then that's good for the economy, as opposed to just saying, "Well, just let the consumers decide." So I'm not sure I'm that heterodox.
So, sort of like step by step, like as a mechanism, how would you view correcting the trade imbalance as improving the capital stock and leading to productivity?
Uh, well, if for example, if the if the dollar went down, so U.S. manufacturing became more competitive in that sense. And the way I would try to encourage that is to discourage capital flows in, right? That would make the dollar go down. And then it's profitable to manufacture things in the United States that it wasn't profitable before. So you're developing the capital stock.
And then, of course,
You're,
that leads to productivity.
uh, yeah, well, let's see. It would be
Sorry, let me be more precise.
yes.
By increasing the capital stock, the marginal productivity of the laborer goes up. Is that
In
your opinion?
manufacturing, it would yes. Uh-huh.
Right, and so you have a different industry mix. Do you have an opinion on either using tariffs or I get you said a minute ago you wouldn't want to use a tariff to correct trade imbalances. Do you have a preferred way to address trade imbalance?
Yeah, I think the right way, and this is a little bit unusual, but I don't see why it is. it The right strategy is to tax. dividends, and investment income that goes to foreigners. So the way I explain this, so if my sister-in-law is in Mexico, if she invests in the U.S. stock market, she's going to pay a 10% rate on dividends and interest, and she's going to pay a 0% capital gains rate. Now, if I invest in the stock market, I'm going to pay a well. My income's pretty low. I'm going to embarrass myself here, but if I were wealthy and I invest, if I let's say wealthy like my sister-in-law, and I invest in the U.S. market, I'm going to pay a 15% capital gains rate. I'm going to pay well for dividends. I'll pay ordinary income. It'll be up in the 30s. Not, and then I got state tax on top of that. I'm going to pay a much higher rate than she would.
Right.
So um, this what this does is it encourages her to invest in the U.S. markets, and it's in a sense it's not free market because it's not a level playing field, or it's as if we have a policy that's trying to pull in foreign capital. And so, in order to invest in U.S. markets, she's going to have to run a trade surplus with me, with the United States, and so it incentivizes uh, trade deficits in order these foreign investors to raise the money to to take advantage of these very low tax rates that they pay on investments in U.S. markets.
So it's almost like you'd like to deal with the trade balance from the other side, right? Rather than dealing with US imports, in a investment side, you want to like attack the export side. Do I read that right?
The capital accounts, yes, exactly.
Yeah, okay. This is good. So just for the listeners at home, so capital accounts might be a phrase that's new to us. Can you give us like a brief textbook style
Well,
walkthrough on
I
that?
mean, um, if you borrow money, I mean, let's say you spend on your credit card. If you spend more than you earn, you're borrowing money. So the loan that's coming to you is an investment in you from a bank or from somebody. And so you run a trade deficit because you're purchasing more than you earn. You're spending beyond your means. And then somebody, in order for you to run a trade deficit, somebody had to give you a loan. So they've got a financial asset. You've got a financial debt. So the capital accounts is dealing with the financial flows. And
Yes.
the current accounts are dealing with the trade flows.
Good. I think that's intuitive. So uh this this idea that you have is very interesting to me. How do you think a policymaker either could pivot from the tariffs towards talking about using taxation on foreign investment as an alternative to tariffs?
Well, you're hitting on the key issue, which is um, the public consciousness is that we want foreign capital to come in because it's like a gift. Uh, they're gonna they're gonna build a plant. The Taiwan semiconductor company is going to build a plant, and this is going to build. It's going to be a big boost to our economy. We got all this this plant and equipment coming in, and this is going to be high-paying jobs. Yada yada. So that's the public consciousness, and so I think the way to twist that around or change that is uh, focus on: is it fair that my tax rate is 20%, 30%, whereas a foreigner gets 0%, 10%. And, I'm not saying this is virtuous, this appeal to envy, but I think if you're doing policy, you sort of go with the negative emotions a lot. So maybe something like that. So why is it, you get some raging politician say, well, why is it that they pay 10% and we pay 30%? I think that's how you sell it. I'm not, but I mean, the reality is it's sort of like correcting the market. You want the rate to be the same for everybody.
Yeah, because there's incentives now that make it more appealing to foreign investors than it does to domestic.
And to me, the real issue is intergenerational transfer, right?
Mhm.
And so that's another way of selling it is um, by encouraging foreign investors to save to their retirement in the U.S. market. We're setting up a situation where the U.S. public aren't saving for their retirement. And so we want to correct that. That would be a more virtuous way to sell the idea.
Yeah,
Um,
they sorry, go ahead.
well, you know, the economists, we say, well, that's a normative issue. Is intergenerational transfer good or bad?
Yeah,
Well, there's another issue, which is the potential downside for having the debt get out of control and not being able to keep up with the payments. This sort of a currency crisis, fiscal crisis
yeah, debt service
a
issue.
paradigm. And I think we're not there yet. I don't think, but it's better to address those kinds of problems before you get there. So
Right.
that's another that's an appeal that's a way of selling it to the intellectual crowd. Y-
So as a US citizen, right, I would look at what are my potential options to do with the money that I might invest, and then the tax rates that I would face on that. And then as an international investor, then I would look at all my different options of where I might invest, and then the US tax rates. So in some ways, it's not even probably a one to one. I pay 30, they pay, I forgot what number you said, 10%. Right, because the US investment might already be more appealing than what their alternative options are, right? The tax rate is a marginal impact on how they would evaluate investments. Do you factor any of that into this, or you're just saying, let's start from the baseline of getting these tax rates the same?
Yeah, I haven't done econometric analysis on how foreign investors would respond to different tax rates. There has been a little bit of work on that. I think realistically, you would roll it out, you would test it. So it would be China because I mean they're the boogeyman.
Yeah, of course.
So you'd say, okay, let's increase. And I looked into this. The tax treatment of foreign investments is set by treaty.
Mhm.
But it turns out that presidents have a track record of just um, re- you know canceling treaties.
Right.
So they don't need Senate ratification to cancel a treaty. And so they could cancel for example, the tax treaty with China, and then if you can negotiate with China and set up a new accord and implement that accord by executive agreement. Once it's so that wouldn't need Senate ratification, and then once it's implemented for a while, I think it'd be pretty hard to change. Effectively, you could implement changes in the international tax rate. WTO isn't a problem either. This would be a broad-based across the board policy. Um, so realistically, you do it with China. Now that's going to set up a lot of um, arbitrage opportunities. China would, would instead of doing investment in the United States, they do investment somewhere else, and the money is just going to
Yeah.
neutral. But you could still get some data that way. You could see how the market reacts,
Right.
and then you could broaden the policy depending on how the market reacted.
And so why don't countries tax the investment income of foreigners to raise money and control trade imbalances? Like, why don't they use your strategy?
Uh, Um, we have tax treaties, um, and
But now
I
you did
think
just say those could go away with the snap of a finger.
no, exactly, exactly. I think the if you're a country who's primarily investing abroad, if you're not a debtor country, you want that tax rate low because it's in your interest.
Right.
So the Germans, the East Asians, they're creditor countries, so they wouldn't be a lot of innovation on let's change these laws to our interest comes from those countries.
Right.
Um, the U.S. is the big debtor, so we're not oriented. Maybe we haven't been thinking that way. Um, I think the history, the long history, the centuries old history is non-tariff trade barriers. And so countries always do non-tariff trade barriers. Whether it's a crazy regulatory
Right.
requirement, um,
Quotas or
uh,
something like that.
limits on foreign ownership of corporations. So we have a long history of that. I think it's just an accident of history. It's relatively new that the international financial system has been so open.
Right. It just hasn't developed yet, maybe.
Yeah, and as long as the U.S. is the big debtor nation, it might not develop
I
because
wonder.
the Mhm.
I wonder if the listeners would think of the U.S. as a debtor nation. I don't think it's obvious to people how that relates to the idea of having a trade deficit. Could you explain that a little bit?
Well, if you so right now, our as a nation, we're $26 trillion in debt to so the U.S. entities owe 26 trillion more than we are. Our liabilities are 26 trillion greater than our assets
Right.
in international context. Um, and so, yeah, break that down to the listener. Why? I'm sorry, I lost the question.
I actually think you answered it.
Okay.
Just in a sense of, I think people realize that the U.S. government's in debt. That there's this big public debt, and I think they have a sense of how running a trade deficit. I don't think those two ideas connect for your
Oh
average
yeah,
listener.
yeah, they're different. The government debt is maybe about half of that, a little bit over half of that is owed to U.S. individuals, U.S. entities.
Of
But then, of course, we got the same thing. U.S. government owes a lot of money to foreigners and plus U.S. companies.
yes. Yes, yes. So for clarity, then, when you're saying the U.S. is a big debtor country, you're talking about the individuals in the country. You're not talking about the U.S. government.
Correct. I'm talking about all of us. Yes.
Yeah, yeah. So it's it's us. It's not the administration. It's not Congress. Not that they're helping, but it's our preferences, right?
No, totally. Yeah, totally. And to some extent, if we didn't have this influx of money from my sister-in-law, this foreign money coming in, buying all U.S. securities, uh, we wouldn't be as in debt because
Mhm.
we would have higher interest rates. We wouldn't want to borrow money at those high interest rates. We'd want to save money. So
Right.
that would encourage a higher U.S. savings rate.
Yeah. It'd be like they took my credit card away, right? Or charged me higher rates on my credit card.
Exactly. It would be like your wife took your credit card away. Yes,
Yeah.
exactly.
Cut that up. No more debt for you. I think people think this taxing of foreign investment is a counterintuitive idea.
Yes.
Um, so if you want inflows from foreign capital, why would you want to tax it? Aren't you going to get less of it then?
Yeah. And the idea is the inflows of foreign capital are effectively subsidizing consumption. They're subsidizing it, you're borrowing more money, which you're going to impose on your children when this foreign capital comes in. I mean, so the U.S. has got enough prosperity to pay for plant and equipment. And alternatively, if you're a politician, you can say, "Well, I don't want to bring in a foreign capital to pay for home mortgages or to pay for a fancy car. I want to bring in foreign capital for plant and equipment, and the yield on those investments is going to more than pay the interest. So it's better for future generations for us to make profit on foreign investments. Uh, that's fine, except for if you bring in foreign capital to finance plant and equipment, then there's more you there's more money available to finance consumption. The money's fungible. But I have no problem with a politician saying, "Yeah, let's bring in money for foreign direct investment," as long as they are willing to tax, um, as long as they're willing to tax foreign investment income and not encourage to limit the overall flow. So as long as they're not being totally honest about it, I'm okay with them bringing in foreign capital. But my concern is that they're by bringing in all that foreign capital, they're feeding the risk of a debt crisis or a currency crisis, and they're also increasing the extent to which we're imposing this intergenerational transfer.
So would the listener do well to sort of view the current inflow of foreign investment as fueling consumption? And you're saying you'd rather see it happen in a way that the structure of the economy is that foreign investment is going towards capital stock. You called it plants and something.
Plant and equipment, yeah,
Yeah, plant and equipment.
from the old days when I did accounting, yes.
Yeah,
um,
that's a foreign terminology to me as an economist. So
yeah. So, um, so the uh, yeah, an illustration. If um, if Trump is speaking, I very seldom hear him speak, but I think I've heard a clip of him saying that this tariff went up and now they're investing in a new factory because they know they're not going to be able to import cars anymore. Then maybe this was Honda. They're not going to be able to import cars anymore because of the tariff. So now they're going to build them in the U.S. So
right.
this is be an example of promoting foreign investment that's going to yield a return that could more than compensate for the dividend or the interest. So there could be a net profit from the U.S. associated with that transaction. But it would be better for our currency. It would be better for avoiding a currency crisis. It would be better for future generations if the Honda plant were financed with U.S. money.
Mm. And how you're proposing that would be from taxes off of foreign investment.
Well, I think realistically, the taxes off foreign investments are, who knows, they're going to be spent before we even see that money.
Of course.
But
So how does that change the incentives such that Honda would build an auto plant in the US?
well, I mean, if if the dollar goes down because of a tax on and foreign investments in the U.S., because we start taxing dividends to foreigners. Uh,
Dollar go down is always a hard sell for
right, exactly.
politicians, right? Yeah.
And the real hard sell with anything, if you're trying to close the trade deficit, you're talking about reducing the standard of living for Americans.
Yeah.
And so
In the
the
short
idea
run
is,
anyways.
yeah, if my wife cuts up my credit card, she's going to be fair on this.
Yeah.
Then she's hurting my standard of living,
Right.
but it might be good for me in the long run.
Right. Yes, yes.
Just like everything she does, right?
Yeah.
So
Wives are always looking out for us in the long run. That's right.
there you go. So uh, it- cutting the trade deficit hurts. It's a cut in standard of living, disposable income for the time being. I mean, well, I shouldn't say purchasing power for the time being. Yeah.
Yeah. Okay. So I think we have kind of a picture of what the basic strategy is, how we might want that to change the structure of the economy, et cetera. Um, let's talk about the scale a little bit. Do you view this as
Let me interrupt a little bit here. Just a thought came to me saying cutting the trade deficit is a in the immediate term is a cut in your standard of living. The same thing for tariffs. So whether the tariffs are a sales tax, and people get the idea that it's a cut in your standard of living. So tax on foreign investment, dividends for that go to foreigners for investments in the United States is also going to it's going to cause uh, a decline in the value of the dollar. It'd be a cut in our standard of living. It's, it's analogous to a tariff. And actually, I think the tariff would be less efficient in terms of the impact would be worse than the tax on the dividends.
Because it's more blunt, or
Because there's excess burden. There's because there's an efficiency loss associated with the tax that you wouldn't have with the tax on investments. Because the tax on investments, you're leveling the tax treatment, and so you should be reducing the inefficiency of
oh,
the
right,
economy. Whereas the tariffs, you'd be injecting an inefficiency.
right. Yeah, that's
You'd be
interesting.
creating an excess burden with the tariffs.
Yeah. You know, not to get too far down a rabbit trail, if I'm teaching, so exactly, well, last week when I gave a talk about tariffs and then I'm talking about trade deficits, to me, kind of the mainstream take is, don't worry about trade imbalances. It's about total trade, exports plus imports, instead of what your actual trade deficit or surplus is. You're taking a different approach to that. I kind of appreciate it because it's definitely refreshing. Do you have the same kind of view in general about trade deficits, or would you take more? You would want to see the trade deficit go down because it's the net borrowing.
Um, to me, I mean, if we didn't have a $29 trillion um, debt to foreigners, I wouldn't even be thinking about this.
Right.
But I guess to me, the issue is the debt to foreigners. It's
Right.
the intergenerational transfer is the issue.
Yeah. That's
Um, I don't even the trade deficit year to year. I don't.
yeah.
That doesn't concern me.
You're saying, but look at the situation that we're in now.
Yeah.
That makes sense. So I'm kind of interested in the scale. One of the things that I uh, reacted to with tariffs, this idea that we're going to levy a bunch of tariffs and then fund the government. I think that's difficult to defend because I don't think you can take in enough revenue to do that. I mean, obviously, it's one of a mini portfolio of taxes that the federal government would use to fund itself. What kind of revenue do you think the U.S. could realistically generate from taxing foreign investment?
Well, the budget. I don't know what it's called. The budget resolution from the U.S. Senate.
Uh-huh.
Um, they put a number in there of 2 trillion in 10 years. That'd be 200 billion a year. And I don't know if that's an increase. I suspect it's the total tariff
No,
revenue.
you're talking about tariffs, not your proposal.
Yeah, this was customs duty.
Yes.
Custom duties collect customs collections for the United States.
Yes.
So
And
tariffs.
and pre 2025, the number's like 80 billion a year. Do I have that right?
Correct.
Okay. And so
Correct.
we're talking about between double and triple that.
Yeah, maybe exactly. 120 billion extra a year,
Mhm.
which strikes me as not that much money.
That would be my reaction, but it's just difficult to think that way with anything that starts with a B, just in general. So,
Yes.
how would your taxing of foreign investment income compare?
Let's see. Assuming we just increase the tax 10%, that's uh, between 300 and 600 billion a year.
Okay, so substantially no, okay, now.
Substantially more. It'd be roughly 3 to 5 times as
Yeah.
much as the tariffs.
So, it, as an economist, I can't hold still when we do projections that don't account for people changing their patterns, right? So if I levy tariffs, how am I gonna collect 200 billion if that is then going to cause the trade volume to fall? Does the budget resolution account for that? Probably not, would be my
Well, to me, this is my number is unfair because I think realistically we would roll it out gradually because it's something we don't have a lot of experience with.
right. You can't jump straight to
So,
20%.
well, no, I was saying 10%,
Okay.
not 20%. So, um, I'm sorry, yeah, from 10% to 20%. Yes, I understand what. So, but we would, maybe start with China, so the effect would be relatively small.
Mhm.
until we found out how it worked, and then we could. I think realistically, once it worked, countries around the world would probably follow suit, and that's good for us because we owe so much money. So it's fine if they follow suit.
Yeah, that's a neat side effect, isn't it?
Yeah. It also, but so the revenue, I think that's more of a long term um, effect. I think there's too many unknowns to really be confident about how much revenue could be raised. But it does. The same goes for the tariffs. You know, so many unknowns.
Yes.
I think the 120 billion extra is a hugely optimistic number for
Optimistic, you said?
for the tariff revenues.
Yeah.
Um, Because as we're seeing, we're not going to implement these large tariffs that were
Yeah.
probably considered in the Senate budget resolution. But so um, 5 years down the road, it might be 300 billion,
Mhm.
400 billion.
Right.
Maybe 10 years down the road. Um, but the another effect of this, which I think is interesting, is um, the developing countries are borrowing a lot of money from China, and one reason that's happening is the United States is pulling all the capital out of the world
Mhm.
with our trade deficits
Mhm.
or with our capital account effects because of our trade deficits.
Mhm.
So it would seem better if we didn't borrow quite so much because we're not helping our future generations.
Mhm.
We're not promoting stability by having this large debt to foreigners.
So by
And at the
so by
same,
promoting stability, do you mean that from a budgetary perspective from our government, or do you mean forcing other countries to go to China to borrow?
oh, I'm sorry. I was thinking of just stability of the currency
Oh,
because the
currency. Okay.
U.S. people owe so much money to foreigners. At some point, you would expect to see a shock devaluation of the dollar. The government, that's giving me a headache if I start thinking about that.
Mhm.
But and then stability in terms of the foreigners, the developing countries. Um,
I guess I'm just arguing it's bad to push other countries towards borrowing money from China. That probably can't end well.
Yeah, and so if the United States isn't taking all the money off the table, then it would be easier for developing countries to borrow from other sources. Yeah.
Yeah, that's interesting. Do you know of other countries that have tried this? You're proposing it for the US, but do we see examples around the world now or historically?
Well, the examples that which has really surprised me, it makes me think I'm crazy, but sometimes people just don't think of things. I'm not seeing examples of people using taxation policy. What I see is non-tariff trade barriers everywhere. The examples I have seen is, well, of course, in the United States, we had the IRA law, we had the 401ks. Those are effectively getting at the same thing. They're trying to promote U.S. savings to reduce that will have the effect of reducing the trade deficit. Um, of course, if we reduce the government, the federal government deficit, that would help,
Mhm.
right?
Yes.
Um, but we a weird policy. The Germans, for a while, they tried subsidizing investments by Germans in foreign markets. So it was like you put your money in, if you get 10% return, we're going to give you a bonus on your return from the foreign investments. Really weird thing. S- Similar to 401k or IRA. The United States would give people a tax break for saving, but they were giving a tax break explicitly for saving in foreign assets.
Well, what motivates that?
I, Presumably, they want to run a trade surplus.
Yeah. Oh, interesting. Oh, interesting. So, do you think this policy you're describing, do you think it complements or do you think it's a substitute for tariff policy?
Well, there's a sense in which it complements because supposedly tariffs are the conventional wisdom is that tariffs are going to cause an appreciation. If the U.S. imposes tariffs, the dollar will appreciate.
Mhm.
But this assumes we're tending toward trade balance. But anyway, that's the standard. The conventional wisdom is that you impose tariffs, the dollar goes up. If you impose taxes on foreign investment income, dollar goes down. So the two would tend to neutralize the effect on the dollar. The two work in opposite directions. So that's complementary.
You'd think, yeah, that would be a good thing. And
Yeah.
so you'd use those together. I had gotten the impression maybe you were proposing this in place, like leave the tariffs, try try this strategy.
I I um I think this approach is better than tariffs. So I wouldn't use them together, but I think realistically, we're going to have tariffs. So
Yeah.
the question of whether these are complementary to the tariffs we're going to have is
Right.
relevant. I, I think the only tariffs that really make sense would be, uh, you know, on specific technology issues that where you don't want technology transfer,
Yes.
yeah, those kinds of things. Yeah.
Yes. It's interesting. Um, you had shared Arnold Kling article with me before, which hits on a lot of the themes that we've discussed now. I'm a big fan of Arnold Kling. Would recommend him to the listeners just almost without reservation. Very good on a lot of topics. A broad commentator on econ. But the thing that you had shared with me, you beat me to it. It was on my reading list, and I didn't get to it before you shared it with me. So I have to give you credit. Is talking about China sort of as a predatory lender of sorts. How do you view that, and how do you think your proposed strategy would uh, interact with that or combat that?
Um, and it's embarrassing, but I don't remember the article. But suppose China is a predatory lender.
Yeah, it's saying, oh, the the trade imbalance between us is because China. I think you had used the word predatory earlier. That the trade between us and China, that China is predatory in that regard. Um, and then Arnold Kling actually then talks about us as borrowers in a similar frame to you. I didn't mean to put you on the spot. I apologize if
Well, no, no. So suppose a country's doing that. Then you could respond. Let's say you're worried that let's say a country's investing in a lot of portfolio assets, and then they're gonna pull money out and manipulate your markets. Uh, Various things they could do. Um, I'm thinking you can speculate what the CIA might do in different countries. They're manipulating our financial markets that way. Well, if you impose a tax on their investments, you're making it expensive for them to do that. I don't think it really protects you very much, though, because
here I have the quote here. Uh, Stephen Mirren, President Trump's chairman of the Council of Economic Advisors, says, quote, in the years running up to the 2008 crash, China, along with many foreign financial institutions, increased their holdings of U.S. mortgage debt, which helped fuel the housing bubble, forcing hundreds of billions of dollars of credit into the housing sector without regard as to whether the investments made any sense. China played a meaningful role creating the global financial crisis, end quote. And then Arnold Kling says the American left like to blame mortgage defaults on, quote, predatory lending. Miran is accusing China of that same evil.
oh, okay, yeah, I think I just read the Mirren quote, not the Kling. So uh, the idea is this, in my view, that traces back to the savings glut. The idea, which was what Bernanke was talking about during that period of time, all this money coming in from abroad, feeding this bubble in our real estate market,
Right.
and um, it. I think it's a little bit. I don't think it's true that they were trying to cause a crash. So the predatory part I don't get, But I do think the right approach to a savings glut is to tax the dividend income, especially for portfolio assets. So whether it's dividend or capital gains, a little bit harder. It might be kind of hard to administer that with foreign ownership. But interest in dividend income, definitely you should tax it, uh, because that's the way to fight back against this kind of a bubble.
Right. Okay, so I mean, you think that dovetails very nicely with your potential tax strategy
Yeah,
to the extent that you would worry about it at all. I guess I should qualify.
in terms of the predatory aspect, they can do that even if we can do that. We're net debtors.
Yeah,
We can go short, we can go long, we can invest in other people's markets. As long as you have an open financial system,
yeah,
people can play games with your markets.
yeah.
So the fact that we owe money doesn't really matter. Um, but
But the structure of your tax policy would.
well, to me, the structure of your tax policy is going to discourage. Um, well, it, it's going to allow. It's a lever by which you can keep interest rates from hitting zero.
Mhm,
So
mhm.
you you got the Fed can continue to have the option of lowering interest rates as long as
Right,
interest rates don't get so low. I think that was Bernanke's main concern was interest rates are so low because all this foreign money coming in.
right. Yeah, there's a lot of discussion about that. It's difficult to move interest rates against the headwinds of the global market, right? Yeah,
Yeah.
that makes a lot of sense. So you're saying, okay, how much can tax policy do against that? Yeah, I understand. I understand the argument. Well, we've been going an hour now, so I'll bring this in for a landing. Let me ask you one last question. Uh, in your view, what are the political and legal obstacles to implementing your tax here, especially as they regard those tax treaties that we discussed earlier?
The political side is just changing the public consciousness to be focused on intergenerational transfers and some sort of a, concern about the debt to foreigners, and that ought to be doable.
Okay. Yeah.
The what I wish people would, I'd like for it would be nice if economists would focus a little bit more on the um, the capital balance, the capital accounts, instead of the current account. And and that's kind of jargon. I'm sorry. It'd be nice if they focused on debt instead of trade. You could get at the same thing. You deal with the same issues from the debt side as you would do with the trade side. So that's kind of my bottom line.
My guest today has been Dr. Fritz Laux. Fritz, thanks for joining us on the Econ Buff.
Thank you.
Thank you for listening to this episode of the Econ Buff, where we find applications of economic thought in a variety of topics and fields. If you enjoyed today's discussion, be sure to check out our previous episodes on YouTube, Spotify, and Amazon Podcasts under the title Econ Buff Podcast, and be sure to like and subscribe. For updates and information, visit our website at econbuffpodcast.wixsite.com. If you have any questions, comments, or suggestions, we'd love to hear from you. Drop us an email at econbuffpodcast@yahoo.com.